Welcome to Rachel's classroom. In this video we are going to see how to calculate multiple methods under evaluations of capital budgeting proposals. So again we are going to see a couple of problems. The first problem here is a company considering an investment proposal to install new milling controls. The cost of the project will be 50,000. Life expectancy is 5 years. Tax is 55% and the depreciation is straight line method. They've given you the profits. So they've asked us to compute payback period, average rate of return, net present value at 10% discount rate, profitability index at 10% discount rate, and finally internal rate of return. So project cost is 50,000, life is 5 years, tax is 55%, depreciation is cost divided by the number of years is 10,000. So the first column here is the years. Profits given in the question. We have calculated depreciation as 10,000. So 10,000 for all the 5 years. Profit after depreciation is determined by subtracting depreciation from profits. Then tax is calculated on profit after depreciation. So on the fourth column value you will calculate tax, and profit after tax is calculated by subtracting this tax amount from the profit after depreciation. Okay, you subtract the fifth column from the fourth column. 0 minus 0, 1000 minus 550, 450, 4000 minus 2200 goes on. See if at cash flow, like I told you in the earlier video, cash flow, to find cash flow you have to add depreciation and profit after tax. We are adding depreciation back because depreciation is not going out of the business, it's still in the business, so it's not flowing out, it is cash flow inflow only. So you add up depreciation and profit after tax and find the cash flow after tax. You find the cumulative value. So in this case the first method that we are calculating is payback period. So cumulative cash flow after tax, we are supposed to get the 50,000 back. So which is the closest value? 44,500 at 4 years. So 44,500 we are making in 4 years. The rest 5,500, that is 50,000 minus 44,500, we get it in the following year. So approximately it takes 4 months. So the payback period for this project is 4 years and 4 months. To calculate average rate of return, you have to divide average profits by average investments. So average profit after tax, you add it up, you will get the average, the total of profits, that is 11,250. You divide it by the number of years, 5 years, you will get the average profits. Average investment is the initial outlay or initial cost divided by 2, that is average investments. So you divide average profits by average investments, you will get the ARR value. The next is to find the net present value. Here we need the cash flow after tax. So we take these values from the earlier table that we have already created, and we use the present value table to find the values for 10%. In this question they have specifically told find the net present value at 10% discount rate. So you will go to the table, present value table, 10%. This is 5 years. So 1 to 5 years value you will take and you will put it in this table. and you will multiply the cash flow after tax into the present value factors and get the present value of cash inflows. The total of these present values is the present value of cash inflow. You subtract the cash outflow. In this case only one outflow is there, that is the initial cost, that is 50,000 into 1. So the difference is minus 4,647. So that the net present value is actually in negative. The next method is profitability index method. Profitability index is calculated by dividing present value of cash inflows divided by present value of cash outflows. We have both the values here in this table itself. The inflows is 45,353 and the outflow is 50,000. So the profitability index is 0.907. The last thing that we are doing in this problem is the IRR. Since the NPV that we got at 10% is in negative, we will choose a percentage that is much lesser than 10% to get a positive net present value. Okay, so here in this case we have chosen 6 and 7%. Again we go to the present value and we note down the values and post it in the table. I'll multiply it with the cash flows and find the present values. Total present value of inflows minus present value of outflows, we will get the net present values. And we use the IRR formula, lower rate plus positive NPV divided by difference in present values. You get the answer as 6.56%. Now let's see one more problem. Here a company is considering a project that costs 2 lakhs, depreciation is 20%. Forecasted incomes before charging depreciation is as follows. They are asking us to calculate payback period method, rate of return on original investment, nothing but your ARR, and they are also asking us to calculate IRR. So first, depreciation 20% on 2 lakhs is 40,000. First column is year, second column is income given. Net income is income minus depreciation. Income minus depreciation is the net income. Cash inflow would be net income plus depreciation. You have to add back the depreciation to find the cash inflows. Cumulative cash inflow to find the payback period. Our initial investment is 2 lakhs. So we are getting 2 lakhs in the second year. So the payback period is 2 years. Rate of second thing that we are finding is the rate of return on original investment. Average net income divided by original investment. So average net income is 2 lakhs. Okay, you have to add the third column. 60 plus 60, 1,20,000. 1,20,000 plus 40 is 1,60,000. 1,60,000 plus 40 is 2 lakhs. So the average net income is 2 lakhs divided by 5, 40,000, or original investment is 2 lakhs. See this, so the rate of return on investment is 20%. Now to calculate the IRR. To calculate IRR, we have chosen 33% and 44%. Since the return on investment is 20%, we have to select a PVF factor value that is higher than 20%. So we have selected, after many iterations, we have selected 33% and 34%. So at 33%, you have to write down the values from the present value factor table for 33% and 34% for 1 to 5 years and multiply it with cash inflows and find the present values. The total is the total present value of cash inflow minus total present value of cash outflow. You will get the net present value. You substitute it in the IRR formula and find the IRR. So in this case it is 33.21%. Thank you.